In today's video, I'll show you how you can build your very own volatility landscape every single morning and use that to pick and choose the markets that best work for you and your trading style. Now, if we start by using today's morning as an example, so that's November 29th, 2021, and this is as of 7:45 a.m. Pacific, so about an hour and 15 minutes after the markets opened. I've laid out our 5 different futures volatility box models as each of their own buckets. So we can even add dividers here to start to think about them as different categories. Now let's start to plug in each of the different index markets first into their respective category or bucket. The S&P 500 and the NASDAQ were both on the aggressive volatility box. The Russell 2000 was on the conservative volatility box model, and the Dow Jones had broken outside of even our doomsday conservative model, meaning the Dow is just not a market we're interested in trading at all. So right off the bat here, we've eliminated one market in terms of our focus. We freed up our mental clarity right there. We now have to pick and choose between either the S&P 500, the NASDAQ, and the Russell 2000. Now, the reason why you may say focus in on the S&P 500 and the NASDAQ would be because you're trying to be a bit more aggressive. You are looking for more trade opportunities. You're looking to try and buy the dip or sell the rip in smaller chunks. So your risk involved per trade is much less, but your reward involved per trade is also less as a result. You're looking to get in and out pretty quickly. On the other side, the conservative volatility box, there your risk involved per trade is a little bit more, but you're also looking for fewer but higher probability trade opportunities. So that's the downside and the upside of each of the different models. Now, if we move on next to taking a look at where the other markets outside of the 4 index markets fits in for today's landscape, here's what that looks like. Gold was on the far left-hand side on the scalper volatility box model. The 30-year bond, copper, natural gas, and silver, all on their aggressive models. And then finally, crude was the one market which had a lot of volatility today. It was on the doomsday conservative models, on the very extreme side of most volatile. And it still was respecting the models, meaning that there were opportunities for trade. It was tradable, unlike the Dow, which had broken outside of it. So that was the difference between crude and the Dow. In today's video, what we're going to do is try and contrast what the aggressive and the conservative volatility box models look like. And I'm going to focus on the S&P 500 and the Russell to help me do so. Now, inside of each of these markets, we had nearly identical trades. We had 2 different sets of trades. The first trade hit both its first and the second target. The second trade was stopped out on both contracts, and we're using 2 contracts for this calculation. With those 2 trades, despite even the stop out, your net P&L on the Russell 2000 was a positive 22.5 points, which translates to 1125 in terms of dollars on the full-size contract. On the other side, the S&P 500, same exact thing, right? One winner hit first and second target, one loser. That one loser was much more substantial in terms of the loss and taking away from our winning points. And that took us down to 6.75 points in the S&P 500, positive P&L of $337.50 to end the day. So you can see the contrast just right off the bat in the P&L. And instead of getting distracted by, I think, the full amount or the total points, the thing that this should hopefully drive home and highlight is your risk involved on the conservative was much greater, and thus your reward is also greater. Similarly, your risk involved on the S&P was smaller, your reward is also smaller, and it's still positive despite getting stopped out on one trade out of the 2 trades that you had for the day. So I think that's the important thing to call out. Now let's move on to charts and take a look at actually visualizing the 2 sets of trades in each of these examples. Let's start with the S&P first, and the first trade that we're talking about came in that 7 to 8 a.m. Pacific hour right here. That's where we had a sell-off in the morning inside of the S&P 500. We breached our volatility box sign entry lines. So if I pull this up, our first part of the setup is hitting these sign lines right here. That happened with this first red candle. So that's step 1. We meet part 1 of the rule set. Part 2 is once we breach that, we're looking for this green arrow, the edge signal, to confirm that, hey, we now officially have a reversal. So that was met with that green arrow right there. Once that happens, our entry is at the cyan entry line right here. Our stop is outside of the clouds. This risk right here is what we're looking at for our potential target as well. And that's what also increases on the Russell, as you'll see in just a few moments. We start first with the S&P 500. This was the first trade in question. Our risk on the first trade was about 6.25 points. Our first target was also 6.25 points as a result. And our second target is at the gray target line right here of that same hour extrapolated. We hit T2 without any real heat. Our stop at that point is at break even. So that was 16.5 points on the second trade in the S&P. So a real nice winner if you think about that. S&P 16 points. We're talking about a real trade here, $800 per contract. That's a nice opportunity. Now, that was a nice winner under a belt. That's how we're starting off the day. The second trade opportunity came, though, as price action breached the upper side of the volatility box in that 8 to 9 a.m. Pacific hour. That's right here. Same exact setup, but this time, short side. The first step was breaching the volatility box. The second step was seeing these edge signal confirmations. That's our entry to get short. We had plenty of opportunities to get short at the sign entry line. Our stop was outside of the clouds. And price in the S&P just continued trending up higher, and you can see the squeeze ended up firing long as well. So everything here basically worked against you, and this was a stop out. The stop out on this trade, including the extra buffer on the trade, was about 8 points a contract. So right here on this stop out, you gave back about 16 points, and that was really that T2 trade that we had right here, the nice winner, and you gave back much of the gains right there. That's how the S&P played out. Once we had the stop out, that was our sign to then adapt to volatility, move up on that same landscape we've been talking about, become a bit more conservative, keep transitioning down the line to the doomsday aggressive and onward. Now, if we switch over next to the Russell, let me bring this up just a little bit. Very similar entry here. Price action selling off. This first red candle where price action breaches is our step one, where it breaches our volatility box edge. We're then looking for this green edge signal arrow. That's step two. That gets hit. And we'd like an entry at the sign entry line. Once that happens, our stop is outside of the volatility box clouds. And inside of the Russell here, that was a bare minimum risk of right around 6.6 points, which is a little bit greater than I think we're used to seeing on the Russell, at least on the aggressive. So that's your additional risk, about $330 per contract on the Russell. It's usually much less that, so keep that in mind. We're looking at a market here like the Russell compared to the S&P, where 330 might be normal risk. Anyways, moving on here, our first target, as a result of risking 6.6, is also that very same 6.6. Our second target is at the gray target line on the other side. Extrapolate that, and the stop for the second target is break even once we've hit T1. Now, in the case of the Russell here, we hit T1, which was 6.6 points, moved the stop up to break even, came pretty close to hitting that break even stop, but fell short of it by a few ticks, and then had a real nice rally where we hit T2 with a break-even stop, and T2 led to about 24.5 points in terms of the total trade, while risking absolutely nothing, $0 on that second contract. And that's the type of trade that I think helps you really justify this and stay inside of trades for a longer period of time, is to try and catch some of these nice home run trades when they do take place. Now, that was the first trade inside of the Russell. The second entry came, very similar to the S&P, when we had a short opportunity. We had price action breach the upper edge. That was step one. We then had two bearish edge signal arrows along with an opportunity to enter at the sign entry line. That was step two. This was our short entry. Our stop was outside of the clouds, which was taken out when price action continued to keep rallying. Now, inside of the Russell here, that second contract stop, bare minimum risk there was about 4.3 points. And you multiply that by 2 for the two different contracts, and on this trade, you gave back bare minimum about 8.6 points. Keep in mind, though, your T2 here, about 24.5 points just on that trade. So you could have done this 3 different times and still have been okay, given that you still hit T1 here and ended the day positive. That gives you an idea of how powerful these home run trade winners actually are, especially on some of these sell-off days where if you catch that real nice bounce, get almost that V-shaped reversal that we've been talking about now for some time, that sets you up for a real nice trade opportunity. So to recap, we took a look at the landscape that we built using that same 10-minute morning volatility process. I've gone through this in many different videos, so take a look, learn this process. It's very, very easy and one you can repeat your own self. We then broke down the charts of the S&P 500 and the Russell 2000, taking a look at both what conservative and aggressive entries look like. We took a look at both the winning trade, which was our first trade in the morning, along with the losing trade, which was the second short that followed up subsequently after that first trade. Hope this video is helpful for both Futures Volatility Box members as well as futures or index market traders. If you'd like to learn more about our Futures Volatility Box, you can do so at our URL tosindicators.com/volatilitybox/futures. Take care, everyone. Good luck trading, and we'll see you in the next update.